Hello, and welcome back, guys. In this video, we're taking a little bit of a look at Alibaba, what is going on lately with the company, why it has been going higher recently, and what is going on with the current news about the division of the company in different parts. This is very important, and it's important to understand why the company is actually heading higher in terms of its stock price because of this news. Now, this happened last week, but we will examine what this means for the company. As you'll see here, the company is sitting at around near $100, and at some point recently it has been about 120. The company has been having up and down moments. Generally speaking, twice having reached 120 in the past 15 months or so. But what we learned, and you can see that in the stock news module of our tool, the tool is actually available for all our patrons, and the link is in the description box below this video if you're interested in becoming one and gaining full access. You will see here that the Chinese ETFs actually surged on Alibaba's breakup plan. And we're going to examine this news because it's important. Now, all of the ETFs basically surged on Alibaba's breakup plan as a response to the company's division plans over here. And you will see that Alibaba itself was up more than 14% last Tuesday, that is, after it announced it would begin operating 6 business groups, each of which will be independently managed by its own CEO and board of directors. So why did investors really like that and actually skyrocketed the stock for that day? Now, first of all, you will see that the 6 groups would be Cloud Intelligence Group. Obviously, they would have to have one that's dedicated to cloud. Very important, makes a ton of sense. And Artificial Intelligence. Taobao, Tmall Business Group, Local Services Group, Global Digital Business Group, Cainiao Smart Logistics, Digital Media and Entertainment Group. So 6 different divisions here. One of the reasons why investors love that is the fact that they're getting excited about potentially new IPOs here. So each of these business groups could become IPOs in the future. And the very important thing that is crucial to understand about conglomerates as Alibaba is that conglomerates tend to trade at a discount. And there are reasons for this one, with the core one being the fact that they have a lot of different parts that are difficult to manage. And so the market tends to assign a discount for these companies. We're going to talk a little bit about it in more detail so that you see what this means exactly. Now, obviously, the shares of Alibaba have been ravaged in the past couple of years or so, maybe a little bit more. And the price has rebounded since it was like about $80, but then it has fallen again, sort of like going up and down. This is what stocks do, of course. But this kinds of news about the future of Alibaba definitely excited investors here. And for this reason, I wanted to talk to you a little bit about conglomerates because before we examine the value of Alibaba itself and its stock, of course, with our tool. The thing to understand is that conglomerates are basically companies that own a lot of different companies in a lot of different industries potentially. So one of the most well-known ones that has been doing perfectly in the past few years is Berkshire Hathaway. And one of the ones that hasn't been doing well is General Electric, both pretty big conglomerates here, selling everything from jet engine technology to jewelry. And this sounds very exciting. I mean, who wouldn't want to own all these businesses? But there are problems for investors here, and these are reflected across conglomerates. Now, the good thing and the big advantage about conglomerates is diversification. Because conglomerates basically act almost like a sophisticated index fund, if you think about it. An index fund is a collection of companies, and a conglomerate is also a collection of companies. The difference is that it's actually decided by the board of the directors of the core company. It's sort of like what the core company acquired, and they can do well. Some companies could have troubles, but it's almost like an ETF if you think about it, owning such a company. Now, these companies can have profitable acquisitions because they can basically buy anything for the most part. They can buy all sorts of companies that are lower in valuation from them pretty much. They have access to financing. All these companies that are below them are almost like kids to the core company, which, all of these can get financing from the parent company. And this is a good thing. This is an advantage for the underlying companies, having all this potential capital to deploy. But there are also disadvantages because the economic risks are there, and if there is a downturn, you will actually feel it. And General Electric, for example, has felt it, and has felt it deeply through the past few years. And the big thing, the thing that investors don't really like, and I myself don't like it as much too, is the fact that these companies are spread too thin. Because if you're into business, if you have been into business, and if you understand things about businesses need to be dedicated to specific things in order to succeed. It's not easy to succeed in an industry, and just by diversifying to all sorts of different industries, it's like you are trying to do great everywhere with everything. And it's just not going to work because there's tons of competition and you have to stay dedicated. And so the fact that they are spreading too thin sort of like doesn't allow them to utilize their core competencies, if they have any, of course. But yeah, the fact that you are owning like companies that, let's just say, fish, and companies that like mine gold, it's a problem because you need to have the particular people, and you need to have the know-how in order to run these companies to its core competencies. And so this is one of the reasons why investors don't really like that this as much, the fact that they are spread too thin in some situations. And this makes a ton of sense. And this is why we're having a conglomerate discount in many cases. Alas, not in Berkshire Hathaway, to tell you the truth. But financial reporting is also tough to understand because, again, when you have all these parts within the company, how do you actually evaluate this? Like, you get a financial report, but is this about exactly? You are actually missing on some details here, and this can be problematic for shareholders that are looking to really, really understand what the company is about. And of course, the conglomerate discount is what I talked about a little bit earlier. The fact that investors assign a lower value or discount to a conglomerate because divisions within the conglomerate are not performing well. I kind of wanted to point out the conglomerate discount Wikipedia page, which I think is very nice here about how it describes the phenomenon. Is the fact that the stock market values a diversified group of businesses and assets at less than the sum of its parts. So basically, you own 5 companies, the market is actually paying 20% less than what they would pay if these companies were bought separately. And this is where investors actually really liked the division part, the division aspect of the Alibaba's companies. This is why they assigned like a 20% instantly, a 20% extra value on top of the stock of the company last week. And the explanation of this phenomenon comes from a conglomerate's inability, what I talked to you about earlier, to manage various and different businesses as well as do focused companies. And therefore, the market penalizes a multi-division firm and attaches a lower multiple to its earnings and cash flows, thus creating the discount, is what you're seeing here. And so a lot of these conglomerates will be actually trading lower than the sum of their parts, is what this basically tells you. And only several star performers, such as Berkshire Hathaway, have managed to escape the market's critical assessment of over-diversification, as you'll see here. So let's go back a little bit here to Investopedia. You can kind of see an example of a conglomerate discount here, which talks about a hypothetical conglomerate, Diversico, which consists of 2 businesses, a beverage division and a biotechnology division. Completely different companies, completely different expected PEs, book values, anything is completely different here. Everything is completely different here. And as you'll see, Diversico, that's again the conglomerate, has a $2 billion stock market valuation and 0.75 billion in total debt, is what they're having right now. And so its beverage division has a balance sheet of 1 billion, while its biotechnology division has a 0.765 billion worth of assets. And so as an example, this article assumes that focused companies in the beverage industry have a market-to-book value of 2.5, while biotech firms have a market-to-book of 2. And so Diversico's divisions are fairly typical companies in their industries, and you can kind of see that the total market value, sort of like the enterprise value of Diversico is the equity plus debt, 2 billion plus 0.75 billion in debt, I'll assign something like $2.75 billion. But the estimate value, using the sum of the parts, is actually higher, is about $4 billion. And so the conglomerate discount is 31% from $4 billion to $2.75 billion. You can kind of see it over here, the breakup value of Diversico versus the market value of Diversico as it is sold right now in the stock market. And so this conglomerate discount shows a deep discount while its share price does not reflect the value of its individual decision, is what we talked about a little bit earlier. And this is why investors, and this is key, might push for divesting its beverage and biotech divisions to create more value, since the company would be worth more if it were broken up into separate companies. So this is why, for instance, spin-offs happen, can provide investors with an increase in value as the conglomerate discount disappears. So now that we understand what happened with Alibaba, it's always important to see whether the company makes sense to buy right now after it's approaching $100. And you will see that the PE ratio is currently sitting at about 44. It's going up and down a lot because recently Alibaba's net income hasn't been impressive. Something that we knew about, but it has been getting better. Now, the net income has been getting better, but the stock price has been getting higher. And so this kind of reflects on the PE ratio. But the price to free cash flow is still pretty low. And you can kind of see here that the revenue of Alibaba has been still growing very nicely. They had some issues with net income, which we fully expect to be temporary. Again, to be expected, remember we had the pandemic, we had all these issues with the Chinese economy. So this is something that we're more than likely going to see disappear in the upcoming months or maybe years, just to be a little bit more less aggressive, I should say, with my predictions. And you will see that the company doesn't have too much debt here. The debt to equity ratio is fairly low. Now, their margins have been hurting, again, understandably, because the net income has been going down. So you would kind of expect that. And so what I wanted to take a little bit of a look at is our stock evaluation tool. The stock evaluator kind of tells us what we expect to pay for this company today. It's a discounted cash flow model for the next 5 years. And the revenue growth of the company has been tremendous, continuing to be tremendous pretty much. Yet we're going to go much lower because we anticipate that this current market may be a little bit worse than what it has been in the past, let's just say 5 years or 10 years. And so we're going to go significantly lower. Let's just go 5, 7, and 10 here for our revenue growth. And the net income margins of the company are not really reflected in the last year because, again, we know that this is a temporary thing. More than likely, we expect something near the 20% region, which has been pretty much the norm in the past few years for the company, 25 to 20%, pretty much. So we're going to go a little bit less just to be a little safer, 17, 19, and 21. And of course, using the tool, you can try all your projections, all your own projections, and see how this changes the potential expected price to pay today. And the free cash flow margin that we're going to use is rather typical for a company like Alibaba here, sitting near 100%. You can kind of see it here. The free cash flow margin is sort of like 90%, 100%, a little bit more in some situations. So I'm going to go 90, 100, and 110. And the annual return that I expect to get from the company is 13%. And I hit calculate. And when I do that, you will see that we're getting valuations of $130, 175, 241, and our current price is less than 100 right now. And so, as you can understand, the company is cheap for what it is. And the fact that you are potentially seeing different divisions and better management in the future does make it even more appealing to me, frankly, even if I didn't own the company, which I do. And my cost basis, I believe, around $94 or so. But I do fully expect the company to recover eventually and pretty easily reach this kind of valuation at some point. May take a couple of years, may take 3 years, who knows? It really depends on what happens with the overall market. But I do feel that eventually the company will be doing much better than what it is doing right now. And I do think that this is a pretty nice price for Alibaba. But do tell me what you think about the company, and I'll see you in the next video. Remember to leave a like and subscribe. See you soon. Bye-bye.